thing to notice about deposits, they're really short term. All the money that you have in your checking account, the bank is required to pay you on demand. Right? Walk into the bank, have them look up your entire checking account balance, and if you want to take every penny of it out, they have to pay you then and there. Your saving account might actually have a few restrictions on it. They might actually be able to require you to give them 7 days written notice. 7 days isn't very long either. So one way to think about deposits, it's really a very short-term borrowing that the bank has undertaken. Now, non-deposit borrowings can be short-term or they can be long-term, whatever they want to do. In general, most borrowing, however, non-deposit borrowing, is short-term for reasons we'll talk about in just a minute. And then, of course, there's the equity capital. This is what the shareholders own. Right? So at the formation of the bank, owners had to put in a whole bunch of money. That's the equity capital. It may have changed with more stock offerings later, but that's basically what the owners have. So those are the three categories on the liability side. So here's another just look at what that balance sheet looks like. So we've got more items on the asset side than we do on the liability side. But as I mentioned, we really want to focus on the asset side on just two categories, cash and loans, because that's where most of the liability assets actually are. Okay? So here's a schematic that shows kind of what this would look like for a typical bank. So reserve requirements are roughly 10%. And with liquid security holdings, we generally find that cash is about 10% or less of a bank's assets, with loans and investment securities making up the other 90%. Now, different banks are very different on the liability side, but it would not be unusual to see deposits be somewhere around 50%, for short-term borrowings to be around 40%, and equity to be around 10%. Now, it's important when we think about this structure of a bank or a bank's balance sheet that we understand where the funds actually are. Where the funds actually are. So notice that the liability side is how a bank actually funds itself. That's the bank borrowing money from savers. But notice what they do with all the money that they borrow. They lend it out over here. So there's not a bank sitting out there that has a ton of cash or funds sitting around in the back room. Yes, they've got that part, the cash up there, but they borrow all of this money here in order to make loans. So it's not as if banks are sitting on tons and tons of cash. Current period a little bit different because banks are holding so many excess reserves. But normally we wouldn't be there. Now, a couple of things about these assets, especially the loans. The loans are typically relatively long-term. Think about 30-year mortgages. Think about 5 or 6-year car loans. Right? Think about 3 or 4-year loans for household appliances. Think about 100-year student loans. That's good. That means you can get your children to pay them off. Either that or you'll be paying off your children's loans too. So most loans on the balance sheet are relatively long run, and they're relatively illiquid, meaning that they're not really easy to sell. Right? So like you make a mortgage, you got all this information about the borrower, it might be difficult to sell that out on the other side. Now, there is something called securitization that has made this much easier, but even with that, a lot of these assets are relatively illiquid. Now, there's one advantage to having long-run, relatively illiquid assets. You can charge a higher interest rate for making those kinds of loans. So think about it. The longer the loan is, the more risk you're taking as the lender, right? Because there's a greater probability that somebody is going to run into adverse financial conditions over a 10-year period than there is over a 1-year period, or over a 30-year period versus a 5-year period. So generally, the longer the loan, the higher the interest rate. The same thing is true with liquidity. The less liquidity, or more illiquid the asset is, the more difficult it would be to sell it. You want to be compensated as the lender for that difficulty. So longer dated loans, less liquid loans, typically have higher interest rates associated with them. That higher interest rate then helps to maximize our interest income. Now, of course, we have interest income on our assets, but remember, we also need to fund all of that lending, and we do that with borrowings. So if we look at the liability side, what we see is those liabilities are relatively short-term. Right? Remember those demand deposits? Their average liability is 0. Savings account, average term, I said liability, average term on a demand deposit is 0. The average term on a savings account is 5 days. Even on certificates of deposit, the average these days is only about 3 months. So banks don't borrow very long term. Even their borrowing outside their deposits is relatively short run and typically very liquid. Well, short term, highly liquid, means that you don't have to pay a very high interest rate in order to borrow the money, which is great because what you have to pay to borrow the funds is your interest expense. And so what you're trying to do is minimize your interest expense. Right? Maximize income, minimize expense. That's how you create a profit. Now, this notion of taking short-term liabilities and transforming them into long-term assets is sometimes referred to as maturity transformation. Maturity transformation, right? Taking short maturity liabilities and transforming them into long maturity assets. Now, the way that a bank makes money in this operation is that they have to have a higher return on the assets than the cost of their liabilities. And this is typically measured through something known as net interest margin. Net interest margin. So the net interest margin is simply the return on assets minus the return on liability, or the cost of liabilities as a percent of the earning assets. So when banks report their earnings, profits and revenue are really, really important, but the most important thing that they report is net interest margin. How much are we earning on our assets minus how much our liabilities costing us? That's what gives us our profits. So whether or not that net interest margin is increasing or decreasing can tell you a lot about how banks are performing. Now, if we wanted to measure the profitability of a bank, what we would want to look at is what that net interest margin is, not the margin, but the net interest that we have, interest income minus interest expense, as a share of our equity capital. Right? So if we look at how much we've made, interest income minus interest expense, divide that by our equity capital, that tells us what our profitability is, something that we refer to as return on equity. Return on equity. Right? So it tells us how much we are earning. Now, another thing that can affect the return on equity, and therefore the profitability of banks, and therefore the compensation of bank executives and the owners of banks, has to do with something known as leverage. So leverage, or the leverage ratio, is simply the assets divided by the equity capital. So of our equity capital, how much are we supporting in terms of assets? And a key feature of that is that for any given net interest margin, the higher your leverage ratio, the more assets you have, the higher the return on equity. As long as your net interest margin is positive, then more assets mean higher profits, mean a higher return on equity. This is why financial institutions want to have high leverage ratios. So let's do an example. So let's take whatever bank this is, and let's suppose that we have total assets of 100. You can make that 100 million, 100 billion, whatever you would like. And we know then that the liability side also has to be 100 because a balance sheet must balance. And let's assume, just for nice round numbers, that equity is 10. So right away, we can see that the leverage ratio, 100 divided by 10, is 10. So this institution has a 10-to-1 leverage ratio. 10 to 1. Okay. Now, let's again, just using nice round numbers, let's suppose our assets, being long-term and illiquid, give us a return of 10%. And let's suppose our liabilities, being short-term and liquid, cost us 5%. So our net interest margin will be the difference between those two, or 5%. So what's our ROE? Return on equity. So our ROE would be our interest income, 10% of 100 is 10, minus the cost of our liabilities, 5% of 100, 5, divided by our equity, 10. So in this very simple example, our return on equity would be 50%. By the way, if you can find that bank, buy its stock. Now let's see what leverage does. Let's assume we keep the same equity, so we're going to keep this at 10, and we either borrow more or somehow we can attract more deposits. And so the entire balance sheet now goes to 200. Now remember, equity is still 10. So now our asset side also goes to 200. Now we're going to continue to assume we get a 10% return on assets, and our liabilities cost us 5%. So our net interest margin is still 5%. Now notice that our leverage ratio is now 20 to 1. And if we wanted to calculate our ROE, it's 20 minus 10 divided by 10, which is 10 over 10, or 100%. Notice that our leverage goes up and our return on equity goes up. The bigger assets that you have, for any given rate of return, the cost of liabilities, holding your equity capital constant is going to give you a higher rate of return. Now remember, return on equity is generally reflected in stock prices, which is reflected in options prices, which is reflected in the compensation of executives. So executives of financial institutions, banks and non-banks, generally like more leverage. So this just gives you an idea then about what the assets and the liabilities look like, what the leverage ratio can do to the rate of return on equity. Now let's think about the risk. So as you're probably aware, the greater the return, the greater the risk. Or I should say the greater the perceived return, typically the greater the risk. Okay? So what are the risks that exist in the financial system? So there are generally three that we think about. The first is what we're going to call bank or deposit runs. Second, liquidity crises. And third, solvency crisis. By the way, one of these crises can lead to another one. So in a bank run or a deposit run, what we have is a situation where the depositors want to take more funds out of the bank than the bank has cash to satisfy those withdrawal requests. Okay? So remember, in a fractional reserve banking system, banks only hold a small fraction, roughly 10%, of their deposits in the form of reserves. If, in fact, people want to take out more than 10% of their deposits, or 10% of the assets, by drawing down their deposits, the bank will not have ready cash in order to meet those withdrawal requests. Okay? This then leads to what we call a bank or a deposit run. So notice here that if, for whatever reason, depositors wanted to take out this many deposits. Oops. Right? They're trying to take out of the bank more cash than the bank actually has on hand. Now remember, this cash is not only vault cash, this is also the bank's reserves at the Federal Reserve System. So one thing that I can tell you is you don't want to be this person right here. Right? So what typically happens in a bank or deposit run is some news gets out about the bank. Typically that it's a little bit shaky, financially shaky. Whether or not it's true, the psychology is such that if it is true, I want to get my money out first. Right? So if you're this person right up here, right, guess how much you get out of the bank? 0. Right? You don't get anything. They're out of cash. Sorry. Game's up. Right? So when these kinds of things happen, what you typically see is a stampede as people run to the bank to liquidate their deposits, which of course then becomes a self-fulfilling prophecy. This happened on a very large scale in the early 1930s during the Great Depression here in the United States. It happened on a very tiny scale in 2008, late 2008 and early 2009 during the Great Recession. It happened earlier this year in Bulgaria. It has also happened in a number of other places in Europe with some of the financial and economic difficulties that they've had. What do you do if you have a deposit run? So notice that you have limited options here. Remember, this is a balance sheet. Assets have to equal liabilities. So if liabilities have fallen relative to assets, there are a couple of things that the institution can do. One, it could try to sell some of its loans. Right? It can try and sell these loans to bring the balance sheet down. Now notice that if they do that, they have to use all the cash that they receive from selling those loans to pay the depositors who want to withdraw money. So it's not like this helps the bank raise additional cash. Whatever they raise immediately goes out the other door. But remember, these loans are long-term and relatively illiquid. So that means they're hard to sell, which means you're not likely to get full value for them if you're trying to sell them quickly, which means you're going to be very reluctant to try to sell these. You might only get 80 cents on the dollar, or 60 cents on the dollar, or 40 cents on the dollar, in which case, of course, now you've got to sell a lot more assets in order to raise the amount of cash that you need. So this is generally not viewed as being a good situation for the bank. Now, what else can happen? You could try to pump up your short-term borrowings. Right? So let's add short-term borrowings to the mix to help push up the balance sheet back up to the level of assets. Now remember, when you are bringing in more short-term or more borrowings, the funds that are coming in are immediately going out again to pay off the depositors. So again, you're not really building a cash reserve here. All your cash is gone. The third thing that you can do is say to the owners of the bank, oh, by the way, all of us owners of this little bank now need to put in more money. Now this may have worked back in the day when there were a handful of owners for most small banks. But now any bank that's a public bank, publicly owned bank, is likely to have millions of shareholders. And guess what? With limited liability, I'm not going to put any more money in. So I don't have to do that. Now, what the bank could do is issue more shares, right, dilute the current shareholders to try to raise more equity capital, and again, to push this up. But notice that in this whole analysis, we haven't said anything about the quality of these loans. All of these loans may have been perfectly good loans. We may have been a very well-managed bank. What's happened, for whatever reason, depositors want their money back. We don't have enough. And now all of a sudden, you've got a bank in trouble. How many of you have seen the movie It's a Wonderful Life? Okay. Those of you who didn't raise your hand, you should see it. It's just a good movie. But in there's a couple of scenes that have to do with bank runs and how they can be handled. Now, it's not likely that it's actually going to be handled that way. So if you want to try to prevent bank runs, there are a number of things that can be done. So the first thing that can be done is you just have banks hold more cash reserves. The more cash reserves they hold, the bigger the deposit run would have to be before it caused any significant problems. The problem with that, from the bank's perspective, cash reserves don't earn anything. So now your earnings on assets are going to come down the more reserves that you hold. You could have, during that period of time, need an equity infusion, right? That was that plus for equity capital. Or they could go out and increase their borrowing. Now, the problem is a bank in trouble is likely to have difficulty borrowing more, or at least borrowing more at a reasonable price, interest rate. A fourth thing that could happen, you have the central bank provide a liquidity injection. In essence, the borrowing comes from the central bank rather than private sector savers. So the central bank is going to give you all the short-run liquidity that you need so that you can then manage the sale of assets, loans, in a more calm way. Or you can have loans mature, and as your borrowers pay you back, use those funds to repay the central bank. So the central bank generally is not taking any risk in this case, because for two reasons. One is because they'll only do this for a bank that has good assets, and second, because they go to the top of the repay list. That is, they get paid back first. And then the other thing that can happen is you can institute deposit insurance. And this is what the United States did in the 1930s after we had massive bank runs during that period of time. So with bank deposit insurance, the deposit run is not likely to kind of feed on itself. It's not likely to be a huge contagion effect. Because in essence, what you have is a government who has said, if the bank can't meet your withdrawals, we will guarantee them. Actually, we'll guarantee them even if they can, but they're guaranteed by the government. So you don't lose any funds. Even if the bank fails, you would not lose any funds. So deposit insurance